What I'm about to say is a very unpopular opinion, although maybe it's exactly what you're thinking. It's unfortunately not what a lot of people want to hear right now because it is very frustrating to think that it could be a reality, and I hate to say it, but after the data that we've gotten, frankly, earnings over the last 2 months, jobs data we've gotten over the last 2 months, basically since I started becoming a bit bearish, right? Like March, I'm like, oh, this isn't good. Had a little bit of a sell-off in April. It was a joke. It was really just part of like the whole volatile Nike swoosh recovery, right? And now we've got CPI data, PPI data, retail sales data. We've broken into GDP reports. We've gotten Jerome Powell multiple times. What is the consolidation of everything? Well, that's what we're going to talk about right now. The consolidation of everything over the last 2 months. Everything that I've been reading from institutions, everything that I base on my opinions, based on the data, everything merged together. Like if there's one thing to just summarize the last 2 months, what would it be? Well, of course, it'd be that there's an expiring coupon code tonight, and a lot of people have been asking for my P&L the last 30 days, so here it is. And that camera is really blurry, and there's a wire in the way. But there we go. So there it is, last 30 days. A lot of people have been asking about it. Yes, the last 30 days have been great. Not every day is great. Not every day is great. I closed some hedges today. If it weren't for those hedges, I would have been green on my trades today. Thanks to with that amazing Faraday play. We had an NVIDIA play. Anyway, some other plays in there. But I did have a little bit of a hedge today, so my trading P&L for the day, because of the hedge going into CPI this morning, did pull me negative relative to yesterday. It was a fraction compared to the profit from yesterday, so it doesn't really matter. But people were asking about the 30-day P&L and my Webull. That's the only place I trade. There you go. Other than when I'm making adjustments in my long portfolio. But no, what really is the point of this? The point of this is to say, and this is frustrating, the volatile Nike swoosh may continue. But not everywhere. I think it's going to be concentrated, and I also hate saying this, but I think there is a chance, at least until we actually get bad catalysts, like bad CPI data, bad jobs data, until we get something like that, the biggest stocks that are at all-time highs might just continue their move. So let me tell you exactly which tickers I'm talking about. Specifically, Microsoft. Look at Microsoft, for example. Microsoft, we're knocking on the door here of all-time highs. I think over the next 3 to 4 weeks, as we wait for more catalysts, there is a potential reality that we frankly just hit all-time new highs. And I mean new high highs on Microsoft. Again, short of some really bad catalyst, I don't know. We had our bleed. We had our bleed. The bleed I was worried about in March, we had the bleed. Now the data's come in and it's kind of washed the problems. We had our bleed on the Qs. Now we're at all-time highs. Meta, we had our bleed. I actually bought the dip on earnings. I got exposure to Meta on that dip. I'm like, no, this is a ridiculous dip. So I never buy Facebook, Meta, but I actually did, and I'll explain why. NVIDIA, I was pretty impressed. I mean, we capped out around 3.5% today, but we did have a dip on NVIDIA as well. I mean, look, we ran all the way down into the 7s. We had the dip. The April dip came. The dip that I was worried about in March, it came. Problem is the dip came and went pretty quickly. It wasn't actually that severe of a dip. What's another one? So we've got Microsoft, NVIDIA, Facebook, Google. Look at Google. Google didn't really have a dip. Google had a dip in February, March, but not that big of a deal. Look at Apple. Apple, I've been buying that one a lot around the 169 level, and it's rocking now that they're talking about actually integrating AI, new product announcements, WWDC, buy the rumor, sell the news, probably coming up. We're in the buy the rumor phase. Point of this is very frustrating because I don't want to be the guy that's like, yeah, it just makes sense having exposure to the biggest names that have the biggest and fattest valuations. But you know why those are doing so freaking well? Are they going to go bankrupt in a recession? No. You know that. Are they going to get the best talent in a recession and fire the worst talent in a recession? Yeah. Do they care about higher for longer interest rates? Yes. But in which way? They like it. Think about this for a moment. Higher for longer interest rates. Who does it screw? It screws entrepreneurs, small businesses, and individuals. Well, guess what that does? In reverse order. The individuals are stuck with the golden handcuffs at these companies, so they don't want to quit because they got buy now, pay later debt and student loan debt and credit card debt and car debt. So they're stuck. They can't leave. And it's tough to get another job right now somewhere else, unless you want to have 2 full-time jobs, which the level of people working 2 full-time jobs is at a record right now. So the individual is getting screwed. Who benefits from the individual getting screwed? The big mega capitalist companies. I'm not trying to be like a Marxist here and go, we need social. I'm not doing that. but it's true. The higher interest rates screw the little guy. They also screw the entrepreneur. They screw the small business. And quite frankly, they screw the interest rate sensitive competitors. Basically, the ones who win are the names that I just mentioned, the ones that are going to all-time high. These are the companies that win because they have massive free cash flow. They use that free cash flow and park it in treasuries and money markets, and they collect the high interest rates. Remember, Microsoft takes in somewhere around twice as much in interest as they spend in interest. So what do they care if rates are higher for longer? They don't. Higher for longer interest rates screw the big guys' competition, and they force their employees to stay at the companies for longer, and they're going to survive in a recession. That's why the indices are basically at all-time highs, because they're so heavyweight, the big boys. Now, people are like, well, wait a minute. Wait a minute. That seems bad. Don't all the others at some point have to catch up? Yeah, they should. But if you go into a recession first, look, everything will tank, right? But the big guys, they might go down 20% and everything else will go down like 80%. You know, and obviously there's some scale in there, right? That's if you go into an actual recession. If you just keep rallying, well, you keep rallying to the tune of basically earnings going up, and who has the ability to keep the best workers and maximize their profitability? It's the big ones. Now, to some extent, companies that rely, like these big companies that rely on a consumer, and that is not an enterprise consumer, they're going to have a little bit more weakness. So, for example, in my opinion, I mean, Walmart reports tomorrow, but we'll see. So we could just use something like probably Target, Etsy, Starbucks, McDonald's, restaurants, local restaurants, Red Lobster, Red Robin, the Jamba Juices, whatever. A lot of these companies are going to come under pressure, even Costco to some extent. They're going to come under pressure, although Costco stock has been doing great. But they're hedged by their subscription model. They're going to come under pressure because people aren't going to be able to spend as much. But see, one of the benefits that companies like, for example, Microsoft have or Meta have is they're not solely reliant on the consumer. They're actually also reliant on enterprise. And so the other big companies using the other big companies keeps them safe. We could even expand, and you could say a company like Oracle. Oracle hasn't had as much of a run as some of these others. Personally, I think it's because probably 9% of people don't even know what Oracle is, and that's okay. But, here's just another company. Or even Salesforce. They've got a lot of competition in sort of the CRM space. Their ticker is CRM after all. But, these are companies that do collect from other enterprise and as a result benefit from these higher interest rates by proxy. It's in part one of the reasons that Dell is skyrocketing. Their AI segment, which benefits from other enterprises, makes up like 2% of their business, which sure, it might double, but again, it's a fraction of their business. But simply because they have that enterprise exposure, the stock's basically memeing ever since NVIDIA gave them a shout out. And since then, everybody's been begging a shout out from Jensen. You can't blame that. But we could look at something simple, frankly, as the Bitcoin breakout to tell us that, folks, we just broke the downtrend. The downtrend has ended. Look at this. I went bearish roughly in the middle of March. Would you look at that? It's when Bitcoin topped out. Now we're breaking out. Why are we breaking out? Because the biggest and best assets are just going to keep crushing it. Now, a lot of me is still 5.5, 6 on the bullish scale, right? 0 being bearish, 10 being full bull. I really, like, I don't see myself just going, oh, that's it, all into these mega cap names. Do I see myself maybe wanting to pick up a little bit more exposure? Yeah, but I can't go all in. I can't go all in margin at how toppy things are right now. And maybe there's a black swan brewing that I just don't see yet. But frankly, over the last 2 months, we've gone through a lot of catalysts, and they just haven't been that bad yet. Now, all of it can go to poopy doopies really quickly. We know that. Things can change and flip-flop very quickly. But you've got a breakout on BTC, and you have, right now, a lack of bad catalysts. Now, what is your next one? We've been through this before. You should know the catalyst calendar. NVIDIA is the next big catalyst. Yes, if they give us some horrible forecast for AI, they could all sell off. But frankly, that might just be the buy the dip opportunity, because your next real catalysts are the jobs data on the 7th and the Fed on the 12th with CPI, but that's 3 to 4 weeks away. And so we're just gonna be sitting here, probably watching some of these stocks just hit all-time new highs over and over and over again. It's starting to feel a lot like November of 2021, where Sarah Eisen on the closing bell every day is like, and another all-time new high. And then the next day, and another all-time new high. And the next day, and another all-time new high.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.